only are we as South African taxpayers compliant, but that we also fully declare the various income sources we have. And this time around, there's been a boom in South Africans getting into the cryptocurrency marketplace, especially over the last 2 to 3 years. And this has captured SARS' attention, so much so that they're actually looking to ensure that South Africans who are invested or either have income from these particular assets ensure that they are open and they disclose this as a source of their income. To give us an update on this particular conversation, we join now by Jashwin Baijoo, the head of crypto asset compliance at Tax Consulting SA. Jashwin, such a pleasure to speak to you again. Welcome to the show.
Good evening, and thank you for having me.
A great pleasure to touch base with you. Well, Jashwin, I guess it's not the first time that we hear of SARS actually looking to target South Africans who have crypto assets or cryptocurrency pockets, but perhaps give us an update as to where we stand with this, because there were certain rules in terms of disclosures, income, trading or investment. Essentially, give us an understanding as to what they're looking for, what kind of assets qualify, and what the taxation rules actually do say.
So the complexity that arises with cryptocurrency, and this is very much more from a generalistic standpoint, is that it's an intangible asset. Mm-hmm. All right. Now, when we consider intangible assets that have a decentralized nature, such as cryptocurrency, where it is not based specifically on current market stocks, is not necessarily based on the JSE. It's not based on Wall Street, but it has its own pegging system. Now, it's currently predominantly pegged against the United States dollar. However, with the decentralized finance element of it, we find that the value chain system is quickly moving away, and currencies such as Ripple and Ethereum are leading the way in that, with your primary currency being your Bitcoin, still predominantly pinned against the United States dollar. When it comes to what SARS are looking at, SARS are ultimately looking at any crypto transactions which are deemed taxable events and historically have not been declared and continue to not be declared, or alternatively, that have now possibly been declared but historically have not. In order to understand that and fully unpack it, we need to understand the classification of specific crypto assets and where they fall in the spectrum of taxation.
Got you. And there's something important that you're saying, that it needs to be declared. And much like any other income that one would earn, it almost seems as though the money needs to make its way out of that particular cryptocurrency environment or wallet and then into your bank account. So isn't this where some of the complexity then arises, where some people actually don't withdraw, they just keep their funds in their digital wallets?
Sorry, could you just repeat that? I'm struggling to hear you.
No problem, Jashwin. I was asking with regard to the declaration process. At what point would one have to declare their income? As many South Africans have actually just kept their crypto assets within a digital wallet versus income that's coming into their bank accounts.
All right. So that one is a little bit complex because your declaration requirement is made in your annual tax return. Okay, so fairly standard. Everyone is used to filing that. And how it is determined is per taxable event. Now, when we say a taxable event, and what SARS considers a taxable event, it is not only the sale of your crypto asset and then the conversion of whatever funds have been realized from that sale and sit in your wallet, converting that to fiat and pulling it out and putting it into your bank account. That's not the only taxable event. Your taxable events when it comes to cryptocurrency include all on-platform activity, which is your crypto for crypto transactions, or cashing out your crypto but storing the value in a wallet. It also includes your realizable transactions, meaning the disposal of a particular crypto token.
Got you.
The funds then landing in your on-platform wallet and you converting those funds to fiat currency and they land in your bank account. It goes on further to include any staking, reward tokens, or profits attributable to arbitrage trading. So even though you are not taking your currency off the platform and realizing it for fiat currency, these are still deemed taxable events and need to be declared on an annual basis.
Whoa. Okay. So there is no way of avoiding the system, right, or identifying these loopholes. So, how would one have to, I guess, ensure that this is adequately disclosed in one's tax returns? Or does this have to be a separate declaration that would be required?
No. So it forms part of your tax return. However, it is not part of your salaried income. Therefore, it's not provided for on an IRP5. Now, what needs to happen is the proactive crypto trader or investor needs to log into the respective platforms they're using and extrapolate their CSV lists, which is ultimately just a very long list of your transactional history. From that CSV list, they need to work through it line item by line item, every single transaction, and consider the profit or the loss per transaction, get a cumulative profit or loss, and then utilize that to prepare their tax computation.
This sounds like quite a hefty exercise, and I guess definitely calls for the assistance of a professional. So I can imagine, Jashwin, you must face a number of clients who say, help, I've either been transacting a lot through this crypto account, I've either been trading quite extensively, I've been mining crypto. Typically, where would one start if they feel overwhelmed?
Yeah, so the thing is there's such a variety, and because regulations have only recently been introduced, there is a lot of market uncertainty. And when you consider market uncertainty, what it typically leads to is panic and either incorrect declarations, under declarations, or non-declarations. The problem is that unless this is remedied very much proactively, taxpayers do tend to face further penalties or implications being imposed by the South African Revenue Service. In order to mitigate that risk, it is always ideal to proactively be compliant and ensure that you've ticked the necessary boxes from the get-go. Where that is not possible, there are alternate remedies available to non-compliant taxpayers who have any sort of historical non-compliance, such as entering the voluntary disclosure program. If there is an estimated assessment by the Revenue Service saying, you owe us 5 million and actually transactionally should be far less, they may engage in the dispute process, granted it's within 3 years from issuance of assessment. And if it is more a case of, in light of the current crypto bear market, where stocks have ultimately crashed, if I'm not mistaken, it's dropped between 60 and 80% in the last 12-month cycle. In those instances where, yes, in the last fiscal period, you made a great profit, you're correcting your declaration, suddenly you have a tax liability due, but in the current period, you're now putting in a loss position. You may then enter negotiations with the South African Revenue Service to apply certain debt relief mechanisms.
This sounds like quite an intricate task, and I can imagine that it would feel or leave a lot of South Africans overwhelmed. But you're right, there are options available. We need to be very clear about the crypto assets that we have. So I guess for South Africans who might find themselves with several wallets, several access to platforms, maybe there's a platform they've forgotten about, maybe experiencing a bit of a decline right now in terms of the performance of cryptocurrencies, and as a result think, I don't have anything to claim for. First things first is to go back and just review what assets you hold, which wallets you have access to, and whether there's a profit or a loss on the trading activity you might have participated in. Would we have that correct there, Jashwin?
Yes, so that is correct. And we've seen a number of times where taxpayers have stopped using a wallet 2 or 3 years ago and completely forgotten about it. I'm sure lots of crypto traders and investors are familiar with stories of individuals who invested in Bitcoin decades ago, forgot about the wallet, and then discover it very recently with 2 or 3 Bitcoin in there, and suddenly they are millionaires before the market crash, of course. And it's very real, and it's not a case of negligence or a case of intention to not declare something. Sometimes it can simply be chalked down to human error. And when that happens, it is not necessarily construed the same way from the perspective of respective revenue authorities, for one. And taxpayers, where there is that element of human error or inaccuracy or inconsistency, it is always ideal to be very proactive in ensuring remedial action is taken immediately, as well as the correct, transparent declarations are then made as a point of rectification.
Got you. Jashwin, sounds like it's going to be an interesting ride for a lot of crypto holders, and seeing how this does unfold in the days to come. It's going to be very interesting. Thank you again for your time this evening, Jashwin.
Thank you so much for having me.
That's Jashwin Baijoo, who's the head of crypto asset compliance at Tax Consulting SA. And as we've heard, there's a lot that SARS is looking into just to ensure that South Africans do claim accordingly and properly. And it speaks to a lot. So if you do or ever have invested in crypto, have access to an account, have at one point owned a wallet and perhaps no longer have access to it, make sure that you just go back to double check those intricacies, right? Because in the end, it might catch up with you. And as we've heard, it's a clear evaluation whether you've been mining Bitcoin, you just bought some, you were transacting or making transfers. All of it at some point actually does apply. It will either speak to capital gains tax or income tax declarations that would need to take place. So be mindful of it, and of course know that it's an investment class that will definitely be liable for tax.